What are you expected? How many copies do you expect to sell?
Depends. I guess as long as the people who buy the book are happy and they like the content, that's the main goal, right? If you can change only one person's life or investment style and improve it, I guess that's good. So not setting too many expectations. It's the first book, so just yeah, let's see how it goes, and if it works out well, let's keep working on new books and so on. And just the most important thing, or hopefully just everybody likes it, and then go from there. Providing a lot of, or trying to provide extra value to the community is a great thing to try and achieve.
I see because I can see your camera. You have a web camera on, and I can see you have a large bookshelf right behind you. Do you like to read books?
Yeah, for sure. So it's like what Charlie Munger said, right? It's really important to always keep learning and keep improving yourself, and just reading can teach you so much about investing, about life, and so on. So also right now I work for myself. I'm running a solo business, right? So doing everything on my own, and this also means that usually from 5 a.m. until 7 a.m. because I'm a early bird in general. Well, I just prefer to read a book and things like that. And then also from 7 a.m. till 9 a.m. I try to read at least one 10K, so an annual report. And when you can do that for months, but even for years or preferably even decades, well, it's like compound interest, but it also works for knowledge, right? So compounding knowledge, well, I guess that's also true in the investment world.
Yeah, it's like music in my ears. What you're just saying. I'll just have a look at the sound, and we'll just get started. Just a sec.
Denne podcasten og innholdet skal ikke anses som investeringsråd. Hensikten med podcasten er å bidra med informasjon om finansmarkedene og selskaper. Podcastvertene er selvlærte hobbyinvestorer og ikke finansielle rådgivere. Informasjonen som gis i podcasten utgjør kun våre personlige meninger. Hvis du legger vekt på noe du har hørt her, gjør du det på egen risiko. Verdipapirer som diskuteres i podcasten skal ikke forstås som en anbefaling til å kjøpe, holde eller selge nevnte verdipapir. Podcastvertene kan være direkte eller indirekte eksponert mot verdipapiret som diskuteres.
So welcome, guys. We have a huge guest here, Compounding Quality, Pieter, with us on Stockup Podcast. He's the founder of Compounding Quality, an investment newsletter with over 500,000 followers across social media and more than 200,000 email subscribers. He has previously worked as an asset manager in Belgium for 3 years. And yeah, Pieter, welcome to Stockup Podcast.
Thank you very much. It's an honor to be here, and I think you guys are doing an amazing job. So just grateful, and hopefully we can teach the audience something new over the next few minutes.
We have the great pleasure of having a copy of your book, and we both have had a couple of weeks to read through the book. And may I ask what was the purpose of the book, and why did you have the idea to write one?
Yeah, so basically I'm running Compounding Quality, so two words, compounding and on the other end quality. So compounding, obviously let the magic of compound interest to the work for you, and then quality by doing that via investing in the best companies in the world, in quality stocks. And I felt like a lot has been written about value investing, right? Writings from Benjamin Graham and so on. So you can read a lot about value investing, a lot about growth investing, like the book of Phil Fisher, Common Stocks and Uncommon Profits. But there aren't many books about quality investing. So that's why together with a friend, I worked on publishing The Art of Quality Investing. And the main goal there is to just give readers an overview of the quality investing philosophy from A to Z. So talking about what is quality investing? Well, it's about investing in the best companies in the world. Well, does it work? Yes, when you look at the data, it works. And we basically build up the entire investment philosophy. So after we talked about what is quality investing, we go into, well, how can you identify these kind of companies? When you are analyzing stocks, well, how can you know whether a company is quality or not? And then next step you will take is obviously the market often recognizes quality. So how should you think about valuation? How are you going to determine whether a stock is interesting or not? And then last but not least, well, if you know how to find quality companies and you know how to look at valuation, well, how can you build and maintain a portfolio? So the main goal of the book basically is that when people have read it, that they know how the entire philosophy works and that they are able to identify quality themselves and to build a stock portfolio full of quality stocks.
Yeah, so that's great, and we had the pleasure of reading an early copy. So when is the date for publishing the book?
So the book will be published on the 15th of April. So really looking forward to that, because as Charlie Munger said, well, the best thing a human being can do is to help another human being know more. So I hope that at least a few people will get some inspiration out of the book and learn something new, because compounding works on the stock market, but it also works in your knowledge. And the more you read, the more you learn. Well, the more you will earn over time, I guess, in the stock market.
Yeah, that's a great way of thinking, and we really enjoyed reading it, because we've read a lot of books, right, Farooq, and this is kind of the first book I've come across that's truly comprehensive on all the stuff that you need to know to identify really good companies. But we could start with the start lesson. What is quality?
Yeah, sure. So obviously you have different investment styles, right? You have value investing, buying cheap companies. You have growth investing, so buying companies the next winners of tomorrow. And then you also have quality. And if you really need to summarize it in one sentence, for me, quality investing is all about investing in the best companies in the world. And a lot of people, a lot of listeners will know the quote from Warren Buffett. Well, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that's exactly what quality investing is all about. And when you are going to look at the entire investment philosophy, well, you can basically summarize it in 3 steps. And that's one, well, you want to buy wonderful companies. So high profitability, high margins, healthy balance sheets, and so on. Second step, led by outstanding managers. So led by managers who love what they do, they have skin in the game, they have their own money in the business, and so on. And then the third step, well, you have wonderful companies led by outstanding managers. Then the trick is obviously to buy those companies at a fair valuation level. And when you succeed in executing these 3 steps successfully, well, you tend to do quite well on the stock market. So that's also, well, another question you can ask yourself, right? So you learned about what quality investing is. Maybe the next question you have is, well, does it work? And when you look at the data, when you look at the historical performance, we can state that yes, quality investing works. So for example, some of you may know the MSCI World Index. So it's a world index with the 650 largest companies within developed markets. Well, when you would just pick the companies that are quality, so the MSCI World Quality Index, yeah, you will see that this index outperformed the market by 3.5% per year since 1994. Same goes for a Morningstar White Moat Index, for example. So this is an index that only consists of companies with a white moat or sustainable competitive advantage. That's something that's really important for quality investors. And well, what you will see is that this index outperformed by 4% per year since 2000. And obviously, yeah, compounding quality. I have my own investment newsletter. I also have my own investable universe, which is available on the website, with 146 quality stocks right now. And we see that this index or this investable universe outperformed 6% since 2005. And most listeners will probably know this. Well, most investors underperform the market, and this is the case for retail as well as professionals. And by just following these very straightforward indices, this very straightforward investment strategy, I guess, well, you're able to do quite well or really well on the stock market in the long term. And I guess that's what everyone wants to achieve over time by investing, to do better than the market, right?
Yeah. What I really liked about your book, Peter, as Kenneth mentioned, both me and him have read a lot of books, and what I found quite original with your book, Peter, is, with all due respect to other investment books out there, is that you actually nuanced the definition of stocks, because everybody is generalizing with, oh, this is value stocks and this is growth stocks, but you have actually implemented the quality stocks, which is actually value stocks, but also growth stocks. If you, it's like a hybrid. Am I right?
Yeah, that's true. And it's also true, right? In essence, every or all intelligent investing is value investing, because every investor tries to buy a company for less than what it's worth. And in an ideal world, the best scenario is that you can find a great business, a company that is still growing at very attractive rates, right? So you could maybe say a growth company. And sometimes when bad things happen in the market, think about what happened during the COVID crash, during the financial crisis, and so on. Well, sometimes those really quality businesses, which are still growing at very attractive rates, become, yeah, you can buy them on the stock market at cheap valuation levels. So then you combine, well, quality investing, value investing, and growth investing. And when you succeed in doing this, well, this offers huge upside opportunities for you as an investor. So in essence, yeah, I would say, to summarize here, all intelligent investing is value investing. You always want to buy a company for less than what it's worth.
Could you elaborate a little? What is your checklist? What is your how do you approach a stock? What is, how do you define quality? Do you have a checklist, or?
Yeah, exactly. So that's also what we try in the book, right? What we try to do in the book, we try to provide an entire framework for investors to find these kind of companies, those great businesses at a fair price. And in the book, we explain, or we are using a checklist to help investors find those kind of companies. And when you look at the checklist, well, you will see that there are qualitative criteria and quantitative criteria. So qualitative criteria, like, is the business easy to understand? Obviously, when you don't understand how a company is making money, well, you shouldn't at all bother and try to invest in it, because you should only invest in what you understand. Other things like, yeah, does the company have a moat? Pricing power is also really important for quality investors. Is it immune to disruption? Is it recession resistant? And so on. So first part of the book will go through the qualitative criteria you need to take care of as an investor. And then the second part is, well, what about the quantitative criteria, right? This is maybe easier because it's easy to measure, and you can use maybe stock screeners like FinChat to screen for these kind of criteria. But think about, yeah, attractive revenue and profit growth. So revenue growth larger than 5%, profit growth larger than 7%. Well, what about the return on invested capital? Another really important metric for investors. So you want a high and sustainable return on invested capital, well, the balance sheet, and so on. So I guess the entire objective is to give investors an entire framework, to give investors an entire checklist, so that when they use the checklist, well, that they can determine for themselves whether a certain business might be an attractive investment or not.
Yeah, and I really like your checklist. It's easy to learn about this thing reading the book, and you provide great examples. I like that way of reading, because then you can get the main rule and then some examples, and then you can apply it yourself. There are a few of them that I'd like to delve a little bit deeper into, if that's okay.
Sure.
And that is specifically number 3, with the company is capable of growing. Because this, I think, is a really important thing. Like, not only do they have to be in a market that grows, but they have to convert the growth opportunity to cash flow for themselves. They can't just be a part of a wave or something. They need to convert it. And so how do you think about finding these companies that manage to do that?
So this is a very good point, right? And it also shows once again you're talking about the ability to grow. So growth investing, and then also we are talking about quality investing here. So this shows once again that growth is an essential pillar of quality investing as well as value. So trying to buy it for cheap. And I think what is really crucial to understand is that a company will always, or the stock price of a company will always follow the evolution of the intrinsic value per share growth, right? And when you know that in the long term, the free cash flow growth and the earnings growth is by far the most important pillar for growing the intrinsic value, well, in that case, I think that it makes complete sense that you want to invest in companies that are able to grow. So that's also why you want to grow or to invest in companies active in a secular trend. And think about companies like trends like obesity, like Novo Nordisk and Eli Lilly, like digital payments, Visa and MasterCard, urbanizations. So those companies are based in the Nordics, right? Elevator companies are benefiting from this, like Kone and Otis, well, hearing aids, also Sonova and so on. So when your end market is growing at attractive rates, well, in that case, I think that it's very straightforward. It makes complete sense that companies active in this secular trends or attractively growing markets, that it's way easier for them to grow their earnings and to grow their free cash flow at attractive rates over time, and as a result, also grow their intrinsic value and their stock price at more attractive rates over time. So what should we try to do, and what's really important is that we try to invest in companies that are indeed active in an end market that is growing attractively, and this will make your life as an investor way easier. And maybe something small to add here, well, organic revenue growth is really important. It's by far the most important thing, I guess. So a company can grow its earnings by cutting costs and so on, but in the end, well, the company always needs to grow its revenue in order to grow or to keep growing its intrinsic value at attractive rates. So growth is really important for a quality investor as well.
May I ask, would you define recurrent revenue as an important key for the companies with growth, or is there more innovation in the picture when you are mentioning organic growth?
Can you repeat the first part of the question, please?
Recurrent revenue. Would you say that's kind of growth if the company has pricing power, and keep up with the inflation? The revenues will grow, or are you looking for a company with more the innovative part?
Yeah, I see. So basically, recurring revenue, obviously, it's really attractive because it's predictable, right? And you know what you are getting, and so is pricing power. So as a quality investor, I guess the most preferred company is always one with a high return on invested capital in combination with plenty of reinvestment opportunities. So think about companies like Copart or Dino Polska that can reinvest basically everything in organic growth. But then you also have another interesting pillar, and those are the ones with pricing power. So think about companies like S&P Global, Moody's, and so on. What is interesting that basically pricing power is also a form of growth, but it's a form of growth without needing any investments, right? Take S&P Global, so it's an American rating agency company. Well, they basically increase their prices every single year by around 4%. So they can grow their top line by 4%, so the revenue, and then they also have some operating leverage that they can grow their earnings and free cash flow by 6-7% per year. So that's really attractive. And then your question regarding the innovation part, well, I guess as a quality investor, you want to invest in companies that have already won, and you don't want to invest in the next big thing. So growth is an important thing, but we basically want predictable growth. So for example, when we talk about AI, artificial intelligence, or other very promising but still loss-making technologies, well, that's not something you are looking for. So we really want to invest in established companies, maybe boring companies, you could say, that have been able to grow their revenue by around 6% per year over the past 3 years, 5 years, 10 years, and where you think that this trend will continue in the future. So for example, once again, S&P Global, well, they were growing at attractive rates 20 years ago, and they were the market leaders. They were the market leader together with Moody's and Fitch in the credit rating market 20 years ago. They still are today, and probably this will still be the case in 20 years from now. So this is very predictable growth, and that's exactly what we are looking for here regarding quality investing.
That's a great answer, Peter. It was exactly what I was actually thinking, because a lot of people think that the next big thing is kind of the golden goose, but it's not. It's a huge bet. So we are not playing with fake money here. So I really like your approach. And how would you define? Is market share an important thing? I know in your book you mentioned a little about moat. Could you elaborate a little about that as well?
Yeah, so the market leadership is also an important thing. Why? Well, you want to invest in companies with a very strong track record, right? Like the S&P Global example, companies that were the market leader 20 years ago are still the market leader today, and where you think that this company will still be a market leader in 20 years from now. And to come back to your previous point, that it's also a very important thing. Everyone knows the famous saying, well, cut your losses and let your profits run, right? This is also the case. Just looking at the stock price over the first or the past 20 years, for example, well, it can already tell you a lot. When a company, and for example with compounding quality, I'm invested in Medpace. So the company was founded in 1992 by August Schundler, and since then they did really well. The stock price did really well as well, and it's still led by the founder, August Schundler, who founded it in 1992, more than 30 years ago. So when that is the case, well, you know that the company is doing something good, right? And that's what we are looking for. And that's also when you look at the portfolio of compounding quality, for example, there are 3 buckets. Well, you have the owner-operator stocks, the monopolies and the oligopolies, and then last but not least, the cannibal stocks. So companies that are heavily buying back their own shares. Well, market leaders, this can also be linked to oligopolies or monopolies. So you want to invest in companies where only a few players or a few companies are active, and they dominate the entire market. So market leaders, also another great example is Visa and MasterCard. Well, they have been the market leaders for decades, and this probably won't change anytime soon. And when you just look at the fundamentals of Visa and MasterCard, their digital payment network has become so valuable that it's basically become impossible for other competitors to take away the market share of Visa and MasterCard. And often you hear about some new fintech company that will disrupt Visa and MasterCard and so on. But what you always see in the end is that they end up working together with Visa and MasterCard just because they can't beat them, and they need to join them basically in order to survive and in order to keep improving. So that's a really attractive thing. And once again, well, you try to invest in companies that have already won instead of the next big thing. So also when you talk about IPOs, for example, well, it sounds very attractive and everyone wants to find the next Amazon, for example, or the next Apple or Microsoft or Google. But when you just look at the data, well, those companies that IPO, that come to the stock market, they seldomly create value. And it also makes a lot of sense, because when you are the manager of a company, when do you want to go to the stock market? When do you want to do an IPO? Well, when you think you can sell your company at a high price. And that's also why, in general, IPOs underperform the market in the next 3 to 5 years after their IPO. So investing in companies that have already won, well, definitely a very important characteristic, if you ask me.
Yeah, and you see that it could take years from an IPO until the company is profitable. Like Snowflake went public in an obscene high valuation. It's come
Indeed.
down to earth since then, but but they have a good business model, of course. But yeah, takes time to.
Absolutely, and it's the same with Amazon, right? Everyone wants to have the next Amazon, but just suppose that you bought it in 1997 for 10,000. Well, obviously today you would have something like 50 million, but you could have never, seen that Amazon would evolve from a loss-making online bookstore in 1997 to the largest e-commerce company they are today, right? And maybe to even add to that, well, when you would have owned Amazon since 1997 until today, well, there would be multiple times that you went minus 50%, so that the value of your stock declined by 50%, and even once by minus 90%. So it sounds very tempting to try and invest in the next big thing, but it seldomly, well, creates value. So the chances you will find the next Amazon are probably something like 0.0000001% or something like that. And that's why we prefer to buy boring companies and do slightly above average for very long periods of time. I think it was Paul Samuelson who said, well, investing should be like watching paint dry. If you want excitement, well, go to Las Vegas, spend your money there, and over time you're sure to lose your money because the house always wins, right?
Yeah, the best thing you can do after buying quality stock is to just sit on your hands.
Absolutely.
Like with the story with Amazon is quite interesting because like almost everyone that bought it in 97 would probably have taken the tax loss, to deduct from a few years later to get something out of it. It's worthless, So at the 10,000 invested down to 300 at the bottom.
Yeah, I completely agree with you. And people underestimate that, but they probably shouldn't. And just have a sound investment strategy. Obviously, pick an investment strategy that suits you as a person, that suits you as an investor. And when you do that and you think on the long term, well, great things can happen to you. And the magic of compounding can work really well for you over time.
Yeah, so I think maybe you could transition a bit over to management, because if you had invested in Amazon 97, that you the only thing maybe that could have pulled you through is that you believed in Jeff Bezos. So how do you find this good management? What do you look for?
Yeah, for me, that's also something that's really, really important. So we already briefly touched upon it. 3 buckets for compound quality: owner-operator stocks, monopolies and oligopolies, and then third, the cannibal stocks. For me, around 70%, so 70%, is invested in the owner-operator stocks. What do I mean by owner-operator stocks? Those are companies with skin in the game. So on the one hand, you have founder-led companies, so companies where the founder is still the CEO and preferably as the majority of shares still. Think about the Medbase example. Well, August Hundle founded it in 1992 and he's still the CEO today. He has a net worth of around $2.2 billion and 2.1 billion of this is invested in Medbase. In that case, you obviously know that he will never make a decision it will never make a decision that harms the creation of shareholder value in the long term. Same goes for Kelly Partners Group, for example. So Brad Kelly founded the company in 2006. He still owns 50% of the business. It's a great serial acquirer. It's a quality stock. So those are the companies we are looking for. On the other hand, because obviously there aren't that many founder-led quality stocks, you can also buy family companies, so companies with an insider ownership larger than 10%, like companies like Evolution AB, right? We said the house always wins. And last question, well, Evolution AB is the house, as they are offering online casino solutions, and they are really making a lot of money from that. Obviously, everyone needs to make the decision for their own, whether from a sustainability and from an ethical perspective. You want to invest in an online casino solution provider, but it's an excellent business. Also, OTC markets, for example, that is basically the New York Stock Exchange for smaller companies. Well, Cromwell Coulson is the CEO there since 1997. He still owns more than 40% of the business. He's really humble. He likes to use the Buffett approach. So that's what we like to see. And also, when you just once again look at the data, you see that, and it's a study by Credit Suisse, well, family businesses outperform the market on average by 3.7% per year, and founder-led businesses, well, they outperform by even 3.9% per year. And what we are trying to do with the quality investing philosophy is we are trying to combine a lot of different characteristics, like skin in the game, like the moat, like pricing power, and so on, that on their own tend to do already quite well in the long term. And by combining all those different criteria, well, you are building your investable universe, and then over time also your portfolio. That's and the goal obviously is to do better than the market. And when your investable universe already or only consists of very great businesses, well, I'm quite comfortable to state that the investable universe we have of 150 quality stocks, well, this list on average will do quite well. So when you would, for example, create an equal weighted ETF based on these 150 names, well, I'm quite sure that in the very long term, so 10 years, 15 years, and so on, it will beat the MSCI World, it will beat the S&P 500. And when you can create your portfolio based on a universe that is already winning, well, that's a bit what you try to do with quality investing here.
It's just amazing to listen to you, Pieter. And I know what I also liked about your book. It's like a recipe when you cook something for your wife or kids and so on. It's like 2 spoons of sugar, 1 ounce of flour, and so on. It's so amazing, and I really like. At the point of you having with choosing quality stocks which are recession resistant, because all of our listeners know that I hate to lose money more than actually gaining them. So I always look for the downside first. Could you also tell a little about your thoughts around recession resistant stocks, because you have talked about them a lot in your book as well?
Yeah, sure. And maybe one thing I will add before answering your question, you talked about the quality investing philosophy like a recipe, right? And I think that's exactly true because I worked in the industry for 3 years. And what I noticed is there are so many really bright people in the industry. So many really smart people in the industry, way smarter than I am. And yet, when you look at the data, well, 80 or 90% of all professional investors, they underperform the market, right? So then I asked myself, yeah, what's the reason for that? And to me, it's mainly that they trade too much, and there are a lot of commercial incentives, and so on. So next question you can ask yourself is, okay, there are tens of thousands of really smart professionals who are working 60, 70, 80 hours figure out the best stocks to buy, and only 10% of them achieves their goal, right? So why would I be different? And I guess that the answer for that is by indeed just using a very rational framework, very rational criteria, that where the past has proven that they tend to do really well, and combining that and base your investment philosophy and your investment portfolio on that. And I guess that's also what separates Warren Buffett, for example, from the industry, to really think on the long term and use a very rational strategy. So that's something really important. Now, to add to your question about being recession proof, it's you are true or it's right. We talk about it a lot in the book because it's really important. Because cyclicality is really an enemy for you as an investor. So as a quality investor, you don't want to invest in companies where you, for example, are exposed or heavily exposed to a certain commodity, like mining companies, a company like Cameco, for example, which is mining uranium, stuff like that. Also construction companies, banks, that's really something you try to avoid. Why? Well, you want to really invest in boring, very predictable companies. So like we already touched upon, companies that have been growing steadily for 10 years or even longer, and when you estimate that it will continue to do so in the future. So that's also why recurring revenue is so important. So when a company has a lot of recurring revenue, well, it's very predictable, right? And it's investing is all about the future. So by definition, you need to make certain assumptions about what will happen in the future. And when a company is really cyclical, well, the risk is way higher because you need to, the likelihood of your assumptions, well, it's way lower that you will be correct. And when a company has a lot of recurring revenue, well, your predictability increases, and also so the odds that you will make good investment decisions also increases. So yeah, really trying to avoid companies that are heavily exposed to certain commodity prices.
That sounds good. Like to have a stable development in the share price feels good.
Exactly.
So I was very interesting to get your take on one of your more original qualitative criteria, and that's the protection against disruption. And just to frame it a little bit, I've been thinking that is really difficult, and I've only kind of seen it with the state-protected monopolies, or businesses with exceptionally unique products like Hermes, the bag maker, or the disruptors themselves like Amazon, Apple. So how do quality companies protect themselves against disruption?
Yeah, I would say that disruption is definitely the worst enemy of a quality investor. Why? Well, you are buying great businesses, but obviously the market often recognizes that it's a great business. So what happens when a certain quality stock gets disrupted? Well, it's a double-edged sword in the sense that, well, your intrinsic value, it stops growing at the attractive rates it used to in the past, and the risk became higher, so also the valuation of the company will come down. So then you lose twice, right? And that's how quality stocks can lose a lot of value. So that's definitely the most important risk for an investor. And take Amazon again, for example. Well, they evolved from being an online bookstore to the largest e-commerce company in the world. Also Netflix, for example, well, they evolved from being a mailing service for DVDs to the largest, well, streaming subscription revenue model in the world. And I think the most important thing, the essence here, is that the company always must keep innovating in itself. So I gave the example of Amazon and Netflix, two very successful examples. On the other hand, you also have Kodak, for example, and back in the days, about 25 years ago, a Kodak moment was referred to as taking the perfect picture. But what Kodak didn't do is they didn't keep innovating. They didn't invest in the digitalization because they didn't believe in it. And then, the company, anyone knows that, I guess, well, they lost, and Kodak is only worth a fraction of what it used to be. So disruption, really dangerous. And how can you avoid this? Well, just don't invest in rapidly changing industries. Invest in companies that have been there for several years, for several decades, have done really well in the past, and where the future still looks bright. So keep innovating, and companies with a strong track record. I think those are the two most important things to protect yourself against disruption as an investor.
Yeah, I think that's really important to look for, because when you look at companies that are that have this innovation mindset, every company say that they are innovative, But you really need to look at their product portfolio and see whether they come with new products and what the revenue are for those new products to see whether their innovation strategy works. If it doesn't, then they are really in a risky position.
Exactly, yeah. And probably also certain industries are way more prone to disruption than other industries. For example, when you think about drinking Coca-Cola, drinking Coke, or brushing your teeth, or drinking coffee, well, those are very boring, predictable businesses, right? But for example, other companies and other industries like cybersecurity, think about Fortinet and Palo Alto, for example, or AI like NVIDIA and Arista Networks. Well, these industries are changing way faster, so the risk for disruption is also larger there, and that's why in general I'm a bit more prudent in investing in those kind of businesses.
That's interesting, really interesting. So I think, Faruk, would you like to talk more about the qualitative, or should we go through the quantitative aspects?
I just have just one question while we're at the disruption part, because I know Pieter is an amazing investor and has a beautiful mindset, and this has been I've been quite ambivalent towards Apple, and I've seen kind of the stocks that you love and that you mention in your book, for instance, Microsoft, Adobe, and so on. Would you say that Apple has a lot of headwinds ahead of itself regarding innovation, or do you think they can live off of services and their iPhone? Because that's been a hot topic on the Discord server and with our other guests on the podcast as well. Do you have any thoughts?
Yes, sure. So first thing, I guess Apple is a great business for sure, right? And everybody knows that it's the largest listed position of Berkshire Hathaway and Warren Buffett. And what Warren once said is, well, maybe I don't know technology as well as other people, or I don't know technology and Apple as well as Coca-Cola, for example, but I know consumer behavior. And some people would sell their second car when a new iPhone comes out. And that's a really attractive characteristic, right? I guess that the main problem that Apple has right now, and it's the case for a lot of companies, is that Apple is such a great business. They are so profitable, and basically they are pouring out so much cash, right? Free cash flow. And they don't have as much reinvestment opportunities anymore. So that's also exactly why you saw that Apple has been heavily buying back shares over the years. And that can be really, really attractive. So those are the cannibal stocks we already briefly touched upon. But what is important to note is that share buybacks obviously only create value when the stock is undervalued. So when a company buys back its own stock, it only creates value when the stock is undervalued. And it makes complete sense. Also, when you as an investor buy a stock, well, you will also only benefit from that when the stock is undervalued. So maybe a slight concern I have with Apple right now is that they are buying back shares at quite rich valuation multiples. And obviously it's way more attractive when you do that at 10 times earnings compared to 20 or 25 times earnings. So that's also something I noticed from working in the industry, is that I was involved in a rather small equity fund, so 200 million euro in assets under management. But when you compare that with Wall Street, that's definitely peanuts, right? But even we could only invest in the larger companies, so companies with a market cap of at least 20 billion euro. And when you have a global equity fund, well, basically everyone is investing in Apple, in Amazon, in Microsoft, and so on. So that's also I took away there, is that when you really do your homework in the small and mid cap space, well, there the market is way less efficient there. And Warren Buffett also said, well, go where the competition is weak. So a lot of value can be found there. And also I think in the Nordics, well, you have a lot of beautiful companies, like in Norway, I think Bouvet, not sure if I'm pronouncing it right, is on my investable universe. We also have Kone, we have Evolution AB in Sweden, you have companies like Technion, Livco, and so on. So when you make your homework in this small and mid-cap space, well, beautiful things can happen to you, because the market is way more efficiently priced in the large cap space, and definitely in the mega cap space.
Great answer, Peter. Could you talk a little about the quantitative criteria you have for high quality stocks? Because you have 4 points there in your recipe, which we have touched a little bit in on earlier in this episode. But could you just go through them for the listeners to know a little about those criterias?
Sure, I'll briefly go through them, and if you have certain question about certain criteria, just let me know. So basically in the book we highlight 4 quantitative criteria. So first one is attractive growth and EPS growth. So you want to invest in companies that have grown at attractive rates in the past, and where you expect that it will continue to happen in the future. So once again, the secular trends like obesity, urbanization, digital payments, cybersecurity, and so on. So that's really attractive. Second point, and it's also a really important one, is high free cash flow conversion. So a lot of people look at earnings, a lot of people look at net income when they are looking at the business. But basically, free cash flow is a way better metric. And when you, for example, would do this exercise and you would compare the companies that translate the most earnings into free cash flow to the companies that translate the least earnings into free cash flow, well, you will see that companies that translate the most earnings into free cash flow, well, they outperform the other companies by 18% per year, 18% per year. So that's phenomenal, and it shows you why free cash flow is so important, I would say. What's the reason for that? Well, free cash flow is way more reliable, it's way more robust than net income, for example. And what you also see is that when a company isn't translating its income or its earnings into free cash flow, well, it might be an indicator that the company is playing with its numbers, making up its numbers. So obviously, that's also something you want to avoid. So you want attractive growth, you want that most earnings are translated into free cash flow. Third part, and probably together with the moat or with the sustainable competitive advantage, the most important thing for quality investors is the high return on invested capital. So really important, and it gives you an indication about the company's moat on the one hand, and also about the company's capital allocation skills. So capital allocation skills is about the decision about what management will do with the money it earned, with the cash it earned, and it's by far their most important task. And what you want to see here is that the return on invested capital is larger than 15%. So also when you use a stock screener and you just screen for the criteria, well, return on invested capital larger than 15%, you will see that you will exclude a lot of businesses, and usually, or it's already a great parameter to start finding quality stocks or finding great businesses. So we have the attractive growth, high free cash flow conversion, the high return on invested capital, and then last but not least, obviously, we want companies to have a healthy balance sheet. Why? Well, a healthy balance sheet gives companies flexibility, right? To do new things, to invest, to keep innovating, and so on. And ideally, best case scenario, well, you preferably even want a net cash position, so that the company has more cash than debt on its balance sheet. And you obviously see that a lot with those great companies, wonderful companies at a fair price, just because they generate so much cash. When you want to quantify this, for example, well, usually I seek for companies with an interest coverage larger than 10 times and a net debt on free cash flow less than 5 times. So I guess those are the four most important quantitative criteria. So attractive growth, free cash flow conversion, high return on invested capital, and then last but not least, a healthy balance sheet. And in the book we are going through or over all criteria. and explain how you can screen and for these criteria and why it matters so much.
May I ask, why don't you use, for instance, return on capital employed? Why are people like Terry Smith favoring that parameter towards return on invested capital? Do you have any answer there?
Yeah, I guess to keep it simple, we mainly talked about return on invested capital in the book, but return on capital employed is also a very good metric, a very important metric, right? So just to go into that, well, how can you calculate return on invested capital? It's basically NOPAT, or net operating profit after tax, divided by the invested capital. When you look at return on capital employed, it's EBIT, or earnings before interest and tax, divided by the capital employed. So the return on invested capital takes into account all the invested capital within the company, while the return on capital employed only looks at the active capital into circulation. So I guess it all depends a bit on what you prefer to use. But once you get a bit more experienced, and for example, you can use stock screeners to try and find great businesses, right? Sometimes you look for a return on invested capital larger than 15% and use this criteria. And then the next time you use a return on capital employed. And for the return on capital employed, I usually use a threshold of 20%. So return on capital employed larger than 20%. And you will see that sometimes you get somewhat different results and some different companies appearing in your radar or on your radar. So that's also attractive. So I would also definitely say, obviously, I want Terry Smith. I'm a huge fan of him, and using the return on capital employed is also a great way to find great businesses. Obviously, it's just a small tweak about what you prefer.
Yeah, sure, because they are actually kind of showing the same. It's how efficient a company uses their own capital.
Exactly.
And that brings us to the valuation part of high quality stocks, Peter, because what you have in common with your, how may I say, idol, Warren Buffett and people like Terry Smith is you love high quality companies. So how would you determine what's a good price? Is, for instance, a company with a higher return on invested capital deserving a higher multiple and so on? Could you tell the listeners a little about that as well?
Yeah, sure. It's also a very good question, I guess. So obviously, when you found a great business led by great managers, the market often recognizes that, right? So it trades at a bit richer valuation levels. But I think it's a complete mistake or a complete misconception to state that the company with a PE, so a price to earnings multiple of 10 times, is cheap, and a company with a PE of 20 times earnings is expensive. So you need to look at the business, you need to look at return on invested capital, and so on. And maybe a great example of this is Dino Polska. So Dino Polska is, if you ask me, it's a great business. It's a Polish company, and currently they trade at 20 times PE. And when you know that it's a retail company, you might say, okay, 20 times earnings for a retail company, that's expensive, right? But when you know that, for example, the company is a high return on invested capital and that they are reinvesting everything back in the business, that they should double in size within the next 4 years, let's say, that they still have a lot of immature stores that didn't reach their full profitability yet, which is why also their net income and their free cash flow is an understatement of economic reality. Well, in that case, maybe indeed when you just look at the PE multiple, it trades at 20 times earnings. But the economic reality, once their stores are fully matured and they stop reinvesting everything in the business, the PE is maybe something like 14 to 15 times earnings. So that's a completely different story. So it's always important to look at all factors. And I think the most attractive thing, the most important thing for a quality investor is a great business with a high return on invested capital, with plenty of reinvestment opportunities. That's really the golden egg for a quality investor. And when you found such a business, well, when it trades at 20 or even 25 times earnings, it can be really cheap in hindsight because they can keep growing their intrinsic value per share at very attractive rates for years and preferably even decades.
Yeah, I totally agree. And the thing is that people may have noticed that the companies, especially large cap in North America, especially in the US, have a higher premium than the companies in Europe with the same growth.
Yeah.
As you mentioned, Dino Polska and so on. And if Dino Polska was an American business with the same growth, it would have had a higher multiple. I'm quite sure of it.
Yeah, 100% agree with you. And correct me if I'm wrong, I think that most listeners are based in Norway here, right?
Yeah, that's true.
Okay, so for compounding quality, most partners, so most premium subscribers are based in the United States. And when you just look at that, when you found a kind of somewhat similar company in the US versus one in Europe, doesn't matter too much whether it's the UK or Norway or Belgium, which is the country I live in. Maybe the company, this exactly the same business in the US will trade at maybe 20, 25 times earnings, and you can buy it at 13, 14, or 15 times earnings in Europe. So obviously this also means that your margin of safety is higher, right? Because the cheaper you pay for something, well, the better and the higher your margin of safety, and obviously also the higher your expected return. So it definitely can make sense to look at Europe and to look at the Nordics because yeah, a lot of great businesses can be found there trading at attractive valuation levels.
Do you know the company Ahold del Heise? Do I pronounce it correctly, or
Yeah, exactly. It's Ahold Delhaize. It's called. I know the company indeed.
do you own it in your investment universe?
No, I don't. And to be honest, I think in general, I think retail is quite a difficult business because margins and so on are quite low. But you have exceptions like right like Dino Polska, but also Costco, for example. Some listeners will also know this company. So what is really important when you have a retailer is that they really have something unique, that they really have a sustainable competitive advantage, that they are more profitable than their peers, that they are better capital allocation skills, so better or higher return on invested capital. And when you can achieve that, well, in that case, I think it can make sense to look at these kind of companies. But for me personally, for Ahold Delhaize, well, I think it's a tough business because yeah, margins are very low, high competition. So it's not in my investable universe personally.
No, I get that. I get that. And Walmart as well. I have it in my portfolio, and Walmart has performed well, both fundamentally and valuation wise. But I do agree, retail is quite difficult. You have to own the winners, as you mentioned before.
Yeah, exactly. And Walmart is another example of a company that did really great, right? And then I ordered the book of the biography of Sam Walton, and it's amazing. And it's also maybe just reading those biographies of amazing founders, amazing business persons. It can be really really insightful, and you learn a lot from that.
Uh, and you used one metric that I've invested for 9 years now, and
Hmm.
I've never seen people talk that much about reverse discount models while evaluating companies. I found it quite interesting. Could you tell us a little about that, and why do you reverse it?
Yeah, sure. It's a very good question, and basically, it was Charlie Munger, which unfortunately passed away on the 28th of November last year. Yeah, I will really miss him during the next AGM in Alma. So also maybe people or you guys listening, if someone wants to meet in Alma during the AGM, would be lovely. But what Charlie basically said is, well, if you want to find a solution to a complex problem, you should invert, always invert. So turn the problem upside down. And most listeners will probably know a classical DCF, a classical discounted cash flow model. But the problem I have with a classical DCF is that you are making so many assumptions. You are making assumptions at the growth rate, you are making assumptions about the tax rate, everything that will happen. And what I like so much about the reverse DCF is that you basically don't make any assumptions yourself, but you just look at the expectations that are implied in the current stock price. So what you basically do is you execute a classical DCF, classical discounted cash flow model, where the upside potential is 0%. Let's give you an example. Well, for example, for LVMH, when you do that, well, you execute a DCF where the upside potential is 0%, and then you will see at which growth, the free cash flow per share growth, that is implied in the current stock price. And the next thing you will do is you determine whether these expectations are implied in the stock price are realistic or not. So to make this a bit more practical, to make this a bit more concrete, well, when you look at, for example, at LVMH, the luxury conglomerate from Bernard Arnault, well, you will see that when you execute a reverse DCF for LVMH, that in the stock price, it is implied that the free cash flow should grow by 10% per year in order to give you, as a shareholder, a return of 10% per year. So then the next question you should ask yourself is, well, do I think that LVMH can grow its free cash flow by 10% per year in the future? And when you look at the business and you've read the latest earnings call, you will have seen that Bernard Arnault has said that the future still looks bright and that they are targeting an organic revenue growth, so organic top line growth of 9%. And this would mean that free cash flow should grow by 13 to 14% per year. So in other words, in the stock price, it is implied that the free cash flow will grow by 10% per year, but management has said that they think free cash flow will grow by 13 to 14% per year. So this indicates that LVMH is undervalued, and that might be an attractive buy. So a reverse DCF is really interesting. You can execute it in a few minutes, and you just look at the growth that is implied in the stock price. And afterwards, you are determining for yourself whether the implied growth rate is realistic or not. If you think it is, you can consider buying the company. If you think it isn't, well, you should wait for another attractive opportunity in the market.
Yes, I think that's a very neat thing to think about, evaluating companies, to be honest, because as you say, the assumption game is really difficult to play.
Absolutely, and that's exactly why you use the reverse DCF, that you don't need to make those assumptions, because every extra assumption you make, you have a chance that you will be wrong in your homework, and if you make a lot of assumptions, well, you can be way off over time. And that's also what Keen said, right? In the long term, it's way better to be roughly right than exactly wrong, and that's exactly what you also try to do with the reverse DCF.
That sounds really great, Peter. We're about to hit the end of this program. Is there anything you would like to add to the listeners?
No, I would say that everyone who made it until now, I think you've been in for about an hour. So I guess that already says a lot about you, about the fact that you are willing to learn about investing, that you have an open mindset. And once again, it was Charlie who said, well, those who keep learning will keep rising in life. So I would say congratulations to them. Also to you guys, because really grateful to be here. And I try to be as approachable as possible. So I really hope that the listeners will like the book, and that if they have questions, feel free to reach out to me via email, via X or Twitter, via LinkedIn, and so on. Because helping each other as an investor, well, that's something beautiful, right? And by working together, we can achieve way more. And it's the wisdom of crowds put to work. So I love that.
Ladies and gentlemen, Peter, the man behind Compound Quality and the book, The Art of Quality Investing. A really, really great job, Peter. I have been so excited to have you on board. And I was really grateful that you actually took the time to talk with us here in Stockholm. I must say, I really love your approach. And the book, I would highly recommend it as actually the first book for people who are interested in quality investing. I would actually say that your book is much better than the Intelligent Investor by Ben Graham. With all due respect to him.
Thank you very much. Benjamin Graham is a big hero for me, so I guess that's too much honor, but I really appreciate it. I really appreciate you guys, and yeah, hopefully people learn something new out of the book, and yeah, let's keep compounding together, and that's the most beautiful thing we can do.
Super. And we always ask our guests, what do you want us to call the episode?
What do you want me to call the episode? Well, the book is named "The Art of Quality Investing," so maybe that would be a good name for the episode as well.
Yeah, I think so too.
Yeah, I think so as well. I've been a lot in Belgium, Peter, and I love the country and the beer and the chocolate as well. Where do you live in Belgium, if I may ask?
Yeah, sure. So next time you are in Belgium, just let me know and let's have a beer together. Basically, I live in a bit above Antwerp, so it's the north of Belgium, and I used to work in Antwerp, and now I'm a bit more in a rural area. I'm more a bit of a smaller town with a lot of local farmers and so on. But I really like it because it's a bit like what Warren said. You stay away as much as you can from Wall Street, and obviously in Belgium you don't have something like Wall Street, or at least it's not as big as that. But just yeah, being able to focus and having the silence and do your own homework and not being influenced by other investors or people who think on the short term. I think that's really beneficial. So I love to live in the north of Antwerp, and it's called Turnhout, the city I live in.
Uh, I love the one of my favorite cities in Europe is actually Bruges, and I love
Yeah.
Brussels. I've been in Antwerp. I love Leuven. Do I pronounce it correctly?
Yeah, sure,
Leuven.
sure, sure. It's a small world, right? Because Bruges is my favorite football team, and my brother is doing his PhD in Leuven, so he lives there currently. So it's a small world.
Yeah, that's cool, Peter. That's really cool. Is there any famous Belgium companies or stocks that are kind of good? Do you have any pioneers?
I guess I'm really jealous about you guys because I think there are way more beautiful companies in the Nordics. I think the company in Belgium that is the closest to being a quality stock is Lotus Bakeries. I'm not sure if you heard about it. It's Lotus Biscoff, so the cookie company. It's a great business. It's a quality company, but it's the only quality company we have in Belgium, and everybody knows that. Which, as a result, well, the company is so expensively valued. It's trading at 50 times earnings for a cookie
Oh,
company, which it is in the end, right? So I would love to own the business, but obviously not at these valuation levels. So that's yeah, probably the best company or the best listed company we have in Belgium, at least.
fantastic, fantastic. Look, Peter, thank you so much. I hope we will have you on board one more time in the future as well.
Yeah, for sure. Let's do that. And I'm also happy to send you some copies of the book, The Art of Quality Investing. And yeah, when you guys are in Belgium once again, definitely let me know, and let's meet each other physically and keep discussing about investing in the stock market.
Yeah, that's great. Thank you so much for your time and all the work that you do for the community. It's it's awesome that you've taken the time to write such a good, accessible, comprehensive book that's easy to read. And yeah, it's really valuable for especially the young investors out there that are eager to learn more.
Yeah, the same goes for you guys, I guess. I think what you are doing is amazing. And I'm using Google Translate here, and I asked it what is thank you in Norwegian, and I'm probably pronouncing it completely wrong, but it says tak skal du ha. So I would say thank you.
Amazing.
And
Yeah, it's very good pronunciation.
Yeah, it was
probably
amazing.
not. And I made everyone who is still listening laugh by now, but that's completely okay.
Super, Peter. I wish you all the best, and we will keep in touch. And we will link to your book and your X account as well on our episode description. And we recommend everyone to follow you on Twitter, or X as it's called now, and to subscribe on your newsletter, because there are some great content coming out there. So a huge shout out to you, Peter.
Thank you very much. It's a true honor, and yeah, always open to help other people. So if anyone has questions, feel free to reach out, and let's help each other.
Super. Have a good night, Peter.
Thank you very much, you too, and talk to you soon.